Okay, welcome to the webinar, everybody. We've got several folks on the call today, and so this is a first in a series of educational sessions that's exclusively for RNG users and Thrive University graduates. We will record these sessions and provide them at a place located on the website for future reference. And we will, if you do have particular questions, Josh is on the call with myself and Robert. Robert will be the main presenter today. I'll chime in, but we'll try to watch for questions. If you have questions along the way, go ahead and type them in, and we can be fairly dynamic today. We can maybe open this. Probably the simplest way to keep efficient is to have you type the questions. And if there's a long question that we have, we might unmute your mic and try to do it that way. But we'll try to keep this as efficient and moving along as fast as possible. One of the things that we realize, we're going to have several topics. I think they'll be quite helpful in maximizing the efficiencies for your clients, framing the math and science so you get to the close quickly, and then also avoid mistakes that are traditionally being made as you're inputting information. We are getting a lot of great feedback for those. We did some different training techniques at the Thrive Universities in San Diego and Nashville, the last couple that we did. And we've had some really amazing early successes from actually the last three, Tampa, Nashville, and San Diego. And so when guys are coming to Robert, and if you haven't made your call yet to spend some time with Robert, which is an offering, of the class and the subscription, it's those folks that have used Robert for an hour or so, getting fast up to speed to the use of the software that really are finding profitability and selling very large cases. So we encourage you, if you've not done that, to go ahead and do so. So Robert, why don't you take us through your first section here and talk to us about what are you seeing out there and what are common mistakes that we can help avoid?
Okay, so today's presentation is going to probably last you about a half hour to 45 minutes, depending on if we have follow-up questions and any feedback you want to provide. And what today's goal is basically to give you an idea of where I've, my experience of working with advisors, where they commonly get hung up, what common mistakes they make with data entry. Today is about talking about getting the data in, spotting your mistakes, and dealing with the data entry side. We will have a follow-up, probably our next next webinar, or maybe a couple webinars down the road. We'll talk about mistakes on entering solutions, but today is about entering the data. Get the data right. That's half the battle. So we're going to start when you're working with putting data in. We don't want you to show the graphs, the charts, the dashboard. We don't want to show the dashboard with the client when we're reviewing data with the client, but it's a good thing to have it up when you're doing data entry. Why? Because if you make a mistake, you'll probably see some crazy thing happen to your graphs that may wake you up to immediate mistake. That's 101. Those graphs are there to help you as well as the client understand what's happening. That said, I'm going to walk you through each section where we typically find advisors make simple mistakes. Sometimes they don't even make a mistake because they misunderstand what the field's for. So let's start with client information. All right, most of this is self-explanatory. All right, the couple of things that are minor that people will make a mistake. And these are going to be small things we're going to talk about and big things. All right, small things just help the presentation look better or make more sense. Simple things like this. We have here the client retiring January 2020. Remember, when you put a date in there, that date is a valid date, meaning this client will actually work in the month January of 2020. What most people don't realize, they think, oh, my client will stop working on January 2020. This is actually the last month they are actually working. So what would happen in this case by doing that data is they'd have 1 month of wages on their reports for 2020, when in reality they've retired 12 of 2019. Small mistake, but it does add to it, because now your first full year retirement isn't going to be 2020, but 2021. So this is a minor thing, but it's something to keep your eye on so that you get that right. I generally, if the clients tell, unless they say I'm retiring on my birthday and I'm going to work in that January, just keep that in mind. It's minor things, and again, that's what this webinar is going to be about: the small things and some big things. Okay, let's talk about big things. Let's get down here. This is the big one we run into all the time, and getting this number right. It's the toughest number to get right. Now, in the application, if you hover over this, you'll get, or over almost anything like retirement age, it'll tell you what we're expecting. Obviously, retirement age is an obvious one. Inflation rate is an obvious one. Something that has a little more depth to it, like this, and this is our net need number, is important. Getting this right is everything. It really is everything. Now let's talk about it. We always talk about the client really has no clue what their taxes are. They just don't. And we've gone through Thrive and how to get that number, and I'm not going to reiterate what we've done in Thrive, but you want to get that number to exclude your taxes, because your client doesn't know what those are, the mortgage payment, because the client's mortgage is going to come off the book at some point. We don't want that as a lifetime expense. Medical, we inflate that usually faster than inflation, so we want that excluded. And insurance premiums, again, they come off the book at some point. The client dies, there's no more insurance, that's no insurance premium. Maybe a 10 pay, whatever. So we want to keep those items out. Now, how do I know if I made a mistake there? How do you know right off the bat? Well, I'm going to show you something. We give you, under the discovery, we give you this summary panel. Now, I want you to look here, and you'll see that it says that's the amount you're saying is today's number, right? This client's going to retire in 2020, 2 years' time. The dollars they will need to cover everything, that would be their mortgage payment. That this actually tells you the total number of values for your mortgage, your taxes, your insurance premiums, your medical expenses. That's an actual summation number right there for you to see that's the total number they will be spending in the first year of retirement. And if that, not this is the net, this is the gross number they need. And now you can look at that number and it says 16.5. Now I want to point that out for a second. This client makes $10,000 and $7,500. This client's making $17.5, and I've got $16.5 as my first year's expenses. Now maybe if I'm 10 years out and that's all inflated, maybe that's fine and dandy. But I got an issue here, right? Because I've got a client who's making $17.5 a month, and their expenses out of retirement are $16.5. Well, that's $17.5. Remember, that's got 401k contributions. My client's probably not making net $17.5. They may be only actually making 16, 15, somewhere around that when I strip out the FICA and the 401k. So this client, I may be overestimating. That's a sign to see. You got to make sure that you see this summary here, that number doesn't exceed their salaries. Because if it's doing that or it's getting close to it, you may be overestimating your expenses. A way to pay attention, re-review with the client. Get it right. In this case, it may be too high. But there are people who want to spend as much or more in retirement. So there's nothing necessarily wrong. Just understand what's going on in that number. Okay. Next issues, medical. Okay, what do I generally see? And I often see this, unfortunately. People just put...
Hey, Robert.
Yes.
I'm just going to pause you. We got a question I think was important for them to understand. And
Sure.
the question was from Todd. It says, you excluded insurances. Where does the insurance expenses come in? When he gets to the life insurance long-term care tab, that will be where the life insurance long-term, there's special instructions on that. And then, of course, in the medical insurance tab, when we add those dollars in, that actually adds to the net income need, but we're inflating medical at one level, we're inflating non-medical flows at a different level. So just kind of hang on, make sure we cover that specifically, Robert, when we get there. But that was one of the questions that come up.
And I will reinforce this concept here. The software will calculate your taxes. You will put your mortgage in. You will put the insurance premiums in separately, and you will enter the medical separately. That's why we excluded them. Those will get added back into this number, In fact, that is why this is 11. And I go back to this discovery. This case is all entered in now. That's why this number is 16,455. I have $5,455 is if you come over, if you look at the mortgage. I've got a mortgage here of $2,000, so it's including that. I've got medical of $500. So now I don't have 11. I have 12. I have 14. There are no insurance premiums. So I have 14, and the difference between 14 and 16,455 is my taxes. So we add that back in to that 11. And that's why getting this right, getting it down, is all inclusive and important. Again, a lot of we've done this in Thrive and discussed how to bridge that, but I want to make sure that you can see a reference point and understand picking up where you may be making a mistake and understanding if you are, because you may think you have this right. Look at this number here. And if that number here, because that's everything all added up, when you've got everything in and that number there is greater than that client's salary or getting very close to that client's salary, you better think about it. They may be actually overestimating their expenses.
So Robert, hold on just a second. Todd's another question. What about property tax and insurance was the secondary question. And so we believe that property taxes are likely going to inflate like food and gas and other traditional expenses. So typically we include property expenses in our net non-medical cash flows, which is under the client info tab. And so you're just lumping that as part of that. But there are states like Texas under certain circumstances where there is no more increased property taxes. So it becomes level. So there's another way for you to enter that so it doesn't have a cost of living adjustment increase to that. So that's going to be uniquely different based upon the particular set of circumstances for the client. But assuming our property taxes are going up like similar expenses, then you would just simply lump it into the net income flows under the client tab. And Robert, open that up just a minute. Just open that tile up and let's focus on that so they're clear. In the client info tab.
Oh, client info, okay.
Go to the client info tab and let's just make sure they understand what we're talking about. So we've put their dates of birth and all. So right there, that's the net monthly income flows for non-medical, because when we put the medical insurance in and we're inflating that at 5 or 6, that's going to be added to the 11,000. If we separate the mortgage payment, which is not taxes and insurance, it's just principal and interest, we're going to go put that in the real estate column. Why? Because usually people have a fixed loan and then that loan is not inflating. That then gets added to this 11,000. So we separate any fixed mortgage payments until they're going to be paid off. We'll show you how to do that. That takes that out, and then we usually include property taxes here unless they're not going up. And of course, the insurance, whether it's medical or whether it's life insurance, we'll get to each of those tiles as we get there. And just hang on just a second. I'm reading some other ones. We want this to be fairly dynamic and useful. So I missed the beginning. Is this being recorded? Yes, we're recording this. Now, the next one is from Terry. For wage earners, do you determine income using box 5 of the W-2 for gross number? Yes, but what happens when you're dealing with a K-1 business owner? That gets a little trickier. So you got to consider the K-1, what's income. But I'll tell you what we really like to use, Terry, is to get to their net income need. We're trying to figure out truly what their current lifestyle budget is and whether their current lifestyle budget is the lifestyle they want to have in retirement, assuming that were today. So even if they say, hey, retiring in 5 years, the question is, if 5 years was today, do you want to maintain the net lifestyle you're currently living? So think about it. When they bring their pay stub, assuming their W-2 to you for both the husband and the wife, once you take a look at their net deposit to the bank account, that net deposit to the bank account is revealed on their W-2 statement. Today, it's usually a direct deposit to their bank. You just got to define what number of pay periods they have in a year and calculate that to a monthly net number. And now you kind of know what at least is the net flows into their bank account. The next question is Is that their lifestyle, or is there significant savings to an emergency fund for which they're routinely not needing all that in an emergency fund? So if they're saying we're putting 1,000 of that in emergency fund and we're only probably using 300 of that a year, that means that you may or may not need to have that same net income. But assuming that net income is what they want to target and they still want to put 1,000 in their emergency fund, that's an easy way to establish what their current standard of lifestyle is. You still have to ask, are you staying within the bounds of that net income, or are you cashing in some other assets routinely to keep your lifestyle up? So is that really truly it? But we use the W-2 to get to the net, and certainly using the gross off the W-2 to get to the gross is fine. But what's coming out of there to get to the net is their medical, which we're adding back in under the medical tab, their group life and disability. If they have any, they've got all their 401k and retirement savings coming out of there, FICA and FUTA, which won't be applicable. And so we're recasting the tax dynamically after we get to the net income flows, and then we're separating out the medical with different inflation. We're separating out mortgages until they're paid off with no inflation. If we got life insurance, it's a 10 pay or a 15 pay. We got 3 years to pay after retirement. We'll show you again how to plug that in under the life insurance tab or the long-term care tab. And then if you need anything unique, there's a separate place for anything that's unique that doesn't fit any of the categories I've mentioned. Again, we'll talk about those. Again, we're trying to start off with what are some common mistakes that we're seeing in the front end. But these are all really good questions. And Robert, I've got some more, so I'm going to try to go with the questions here. See, if I'm working with a client who wants $400,000 a year of income, medical and those other miscellaneous expenses are rather small, any problem with simply entering $35,000 a month? That's a great question. When we have clients that are $20,000 and above for income, oftentimes the micromanagement of thinly slicing all those pieces, knowing you just have plenty of income and whatever the different inflation factors over time are immaterial. Yes, you can actually do a different way of inputting to not focus on doing medical. So just ignore it. Not focused on any other expenses that you're not worried about, and only entering those expenses separately that you would be worried about on a larger case. And you can just simply plug in that 35,000, assuming that was your net number, and it'll gross up the tax. And you can ignore all the other smaller elements for sure. Let's see, I missed, okay, that was, let's see if we've got any other questions here. Yeah, we got questions coming in here. Let's see, let's see, thanks, got it, thanks, and howdy, Eric, hi Eric. Let's see, should properly insure, should property insurance be input then? Again, if property insurance is going up in expenses, much like food and other housing expenses, I would say no, just lump it in right here under the desired monthly income. Make sure that number is going to be enough. And but there are states where there's no more increase, like Texas in certain circumstances, and then you can go out and enter that. You can enter that in a different way. What you don't want to do on the real estate tab is you don't want to incorporate taxes and insurance, because those are ongoing living expenses that continue past the payoff of mortgage. And so Robert, cover that when you get there. I think, Robert, go ahead and move on. I'll interrupt you again with questions in a while, but let's keep moving here.
Okay. So, and I'm just going to re-summarize this real quick. This field is for if you have items that inflate at a different rate than this, or do not inflate at all. Insurance, life insurance premiums, mortgage, and medical inflating at a different rate. You exclude that out of here. If you have things that you want to inflate at a different rate or disappear, maybe you're gifting for the next 6 years, don't include that here. We have a place you can enter other expenses that are not permanent and not going at this percentage. So again, with the real estate taxes, if you have a fixed rate, New Jersey is the same way as Texas, you're 65 and older, you can freeze your real estate taxes. So pull that out, we'll enter that separately. And it will total up in this field, okay? It will total up. So if you enter any expenses over here under life insurance, under medical, they'll be included here, and you'll see the summation of that number. And that's the number you want to focus on. Because if that number there, because that's going to be what we're going to spend in your first year of retirement, that number seems too high, then you need to review what's going on. Okay? So let's go to medical.
Robert, you have all the inputs here. I wonder if you could just quickly fast forward. I know you're not got all the inputs in. Just show them the cash flow need statement. Just show them how all those pieces finally come together. If they can see the end as we're going through this, I think it might settle down some of the questions with regard to how all these come together. So just kind of walk across and stay focused on the baseline for a minute.
The Colin's first full year retirement, this is their core expenses inflated.
At 3%.
This is their medical from Medicare, which we're calculating. The client doesn't know what that is.
Yeah, so understand there's no place for you to incorporate additions for costs of Medicare Part B. Why? The reason that is because Medicare Part B is subject to their income. And then we have now IRMA, right? We have to worry about the surcharges that are going to come into play above certain income levels for single and joint. And so if we're doing a tax return, we basically know what tier and what surcharges are going to be required to pay. And so we're automatically inputting the cost and the tier of the cost for Medicare Part B. You're not going to find any place for that input. It's just automatic like taxes are. So don't worry about it, but it will show up right here in this report. Then what you're putting into the medical is really any pre-65 costs that may be different than post-65 costs that are Medicare Supplement, Medicare Advantage, and Medicare Part D. Now, sometimes if we're using a 5% inflation factor on medical, it's sometimes a standalone long-term care. People are worried about building that in. You could enter your costs for long-term care where you're paying all years as part of that cost if you want to. I'm not sure I would. I'm not sure it's going to be a 5% static increase in premium for long-term care. There's another way to do that. But the medical that you're putting in has nothing to do with Medicare Part B. That is going to come into the programming report dynamically, and this is where you're going to see it in that report.
So here you'll see these columns here, other expenses, Medicare, other medical, life insurance, and liability, and taxes. These 6 items here are items we're calculating outside of their core needs. These are items that we typically think will inflate differently or come off the books. For example, your mortgage, we figure it out, is going to end somewhere here. So that need goes off the books. Okay, and that's why we segregate these items. Medical is going to inflate at a higher rate. We want to segregate those items. Life insurance premium be like the liability. That number will come off the books at some point. Taxes, you don't know what the taxes are. The client doesn't either. That's why we segregate. We don't let the client say, I need $10,000 including taxes. They have no idea what their taxes are going to be. So how could they tell you that's how much they need? They don't. So that's how we want to knock down to this core number and segregate the others. Getting that right solves most of your mistakes in a plan. And you use this report here to confirm your numbers make sense. All right? Come back to that later because that's part of the discussion later. So back to discovery. Medical. I find too often people underestimate medical. Listen, when the consumer, x-rays aren't going up more than 5%, going up 5% a year. The cost of an aspirin isn't going up 5% a year. The thing is, as we get older, we use more of them. Thus, our cost is going up more than 3% or 2% because we're consuming more. You shouldn't use anything. You really shouldn't use anything less than 5%. Now, it's your decision, and this is not a mistake-prone and accidental error. It's a conscious one by the advisor, but you should get that right. It makes a big difference. We consume way more as we get older. We want to get that right.
And then, Robert, if I can add to that understand, I'm going to talk post 65. It's across the country, generally speaking, a 65-year-old total cost per spouse for Medicare Plan F, if you still have it, and a good Medicare supplement, somewhere between $150 and $200 a month. And that's as much or as little as I see as I do these plans around the U.S. Now, that doesn't build anything for any out-of-pocket, but if I have Plan F, I have no out-of-pocket. as long as all my procedures are Medicare approved. The only risk I have is the donut hole and medications. So I can throw a little bit of donut hole payment in there on top of Medicare supplement, Medicare Advantage, or Medicare Part B, or excuse me, Part D for the drugs. But you're doing that per spouse here. And if I look at least most of the regions I've tested on what the increase to the premiums are, not the increase to healthcare costs, but just the increase to premiums, it's about 5-6% across the board. So if you're mitigating good insurance for healthcare costs, the only inflation you really have to worry about if you don't have out-of-pocket risk is really the inflation to the premium increase, not necessarily the inflation to the medical costs. Now, I'm not talking about long-term care or extended illness. I'm talking about just basic health insurance needs throughout retirement. So putting in Medicare supplement, Medicare Advantage, or Medicare Part D together with any donut hole concerns on a monthly basis on post-Medicare with a 5 or 6% medical inflation, you pretty much cover that nut of cost. And then, Robert, talk about when you would exclude Medicare. Younger spouse, older spouse, he's taking benefits under her while she continues to work, and he's past 70. I mean, what would that look like? You see the slider to the far right. We should probably cover that.
Yeah. Okay. So let's go further on. So I'll get to that in a second. So let's talk about mistakes that you may make in this field. So this is your medical. Make sure you got that right. I often also see this problem. People don't realize or they don't think about that we are calculating that Medicare tier. You don't have to think about the Medicare. So in this case, this entry here is probably erroneous because they're saying 150. They're assuming 150 for my Medicare plan and 130 for my tier. So they're putting $280, $300 in. No, we are already doing your tier. This is typically 150 to 175. Now, you may want to open that up, as Curtis said, because of your client has more drugs than normal, or maybe they have a lot of dental, or they go to a therapist, whatever. But generally, this number runs between 150 and 175. We'll do the tier. So getting that number correct is important. A common mistake made there. Turning this off on, this is nothing more than for those, say you have a federal employee you have federal employees who do not pay Medicare. Or in New Jersey, for example, teachers do not pay Medicare. Or they pay Medicare, but they get reimbursed for their tier. So they effectively don't pay Medicare premiums. So you may need to exclude, that's what that field is for. And generally, you're not going to run into that too often.
So, hey, Robert, I want to just make a point to the question asked earlier. If I've got somebody who just says, give me $35,000 a month, figure out what the taxes and gross it up are. If you're just doing an easy high-level illustration like that, all these particular details that we're covering in this field are completely irrelevant. If you're saying, I'll have enough, I'll pay my expenses and live on the rest, whatever that is, then you can avoid these thinly sliced pieces of detail. Just leave them blank.
All right. Let's move on. Real estate. Okay. Normally, I don't have any problems here. We don't see too many people. This is pretty self-explanatory. Mortgages, what I do commonly see is someone will enter the balance, but not the mortgage payment. If you don't put a mortgage payment in, the balance never gets paid off. And of course, I won't be able to account for that being paid off at some future point. Now, given to the client what Curtis was just discussing, and I want to do the big picture, fine. If they're just doing a big picture and they got they're just on one big payment, it'll cover everything, including the mortgage, that's fine. We're not going to worry about that. And you want to keep the liability on the books, that's fine. But understand that liability will stay on the books until it gets a payment. No payment, no liability disappearing.
And then I think the other thing that we see often, Robert, is, if you could stay there for a second, the other thing that we see is they forget to take out insurance and taxes. When we put in the payment, because we're trying to find the precise month that payment balance is paid off, and we can reduce the income need by the amount of that payment, to make sure that the taxes and insurance are not included here. And if you lump them into the net monthly income need under the client info tab, that's typically where we put in when we're putting a traditional inflation factor on that, just excluded here. And then if you want to separate the taxes and insurance. Don't put it in here. We'll show you a different place to do that, and he's getting there next. So just be careful that you do that. Make sure you're also getting the balance, the accurate balance. It's best to get a statement, and make sure you're using the correct interest rate. If you plug that data in correctly and you put in the actual amount of their principal and interest payments they're making, and some people are paying faster than their billing requires, but whatever they're paying to that, the system will automatically calculate when that's paid off, what month and year it's paid off, and it'll reduce the income need that's drug as a distribution rate from their portfolio automatically for you, and it'll lower the taxes because the payments are less. So be sure you're getting the full advantage of the software because it does that heavy lifting.
Okay, other cash flows. Most common error here in Social Security is these fields over here are if you are either your client has already started their Social Security, or say your client comes to you and says, I'm going to turn 64, I'm retiring, and I went to Social Security office and they said next month if I start my Social Security it will be X dollars starting June of 2000 or July of 2018. So whatever you want, if you want to preempt the calculations over here, that's what that does. But if you put something here, doesn't matter what you check here, we will use the value that's already collecting. If it's greater than $0, that's the amount we'll use, and we'll use it whatever date you say, and we'll start it then. Column, that sometimes people forget. I actually do this often. I'm rushing through and I forget to give myself a column. That's not a harm. It's not a foul, too bad. Social Security hasn't been going up all that much, but the client doesn't want to see that this number is fixed forever. So I generally use 1%, so they see that there is some kind of increase. All right. Pensions, really not a really big problem here. I just generally don't see any problems. Just, of course, make sure you don't forget things like this. We have these sliders. The spouse is important because whichever spouse lives or dies is when that ends. Other income. So I'm going to explain some things here that maybe people don't know. I've been using the software for a while because there was a change. With the Tax Act, this taxable pass-through field or option, if you have someone has a partnership, an S corp, a C corp, and they have passed they qualify for the 20% deduction from the new Tax Act, well, that's when you want to use this field. That will give you the 20% deduction on the income earned. Okay. One other thing, you can't have income for 1 month. The software will not recognize income for 1 month. So don't try to say, oh, I'll put money in for 1 month. Won't do it. It will only do income from at least this point to the end of this year. You can do it for 6 months, but it's not going to work for 1 month. Okay. Other expenses, nothing there you have to worry about. This is a common mistake, and we did kind of highlight it here. These are one-time incomes and expenses. What will happen with these one-time income or expenses, they come directly out of your non-qualified assets unless you don't have enough. So if you're an expense, then it'll come out of non-qualified and then qualified. But an expense is a negative number, and a positive number is used for a source of income. Okay.
So Robert, would they put that in a different place?
No, it's perfectly acceptable to put things here. You just want to use a positive number if you're receiving money and a negative number if they're not. Now, most of my expenses, I just put here. I just generally don't use that. I use it mostly for an inheritance, receiving a gift, or something of that nature, and I usually put my expenses up here. It'll show up on the report here, but anything you do here is nothing more than an adjustment to your assets balances. So I just generally don't put it here because I won't get to see that money coming in or going out on a cash flow statement. I want to see.
One other question. When you were saying it won't pick up 1 month, it won't pick up 2 or 3 months, in the excess cash flow and miscellaneous info, can we just throw that in as an additional sum of money received, or would we put it somewhere in here?
So that's your choice. If you put it here, you can say I just got $24,000 for the year. that $24,000 will be directly deposited into your qualified account, your non-qualified account. It'll just come straight in. If you put it as other income, which is also an option, the benefit of that is that the $24,000 you can put as $2,000 a month for 12 months. The benefit of that is it will show up on your cash flow report as money coming in, $24,000. And then, of course, if you make it an expense, it will show up as an expense for 24. The downside to doing it this way, putting the income here as opposed to here, is here the money goes right into your non-qualified account. Here it comes in as cash flow. So if you make the money that comes in as a $24,000 to this year's income or next year's income or whatever year income you're talking about, then that money is immediately available to pay expenses. So if you have a shortfall that year of $24,000, that money would come in and then go right back out to cover the shortfall. Whereas if you do it down here, the money would go directly to your non-qualified account. And if you have a $24,000 shortfall and you've chosen to draw down for shortfalls first from qualified assets, then the software will take the money not from your non-qualified, it'll let you receive that money, deposit it into non-qualified, and then take the shortfall from your qualified assets. So by putting it here, you have more control of where the money's going and then where it should come from. If you put it here as other income, it's going to come in as cash flow and be first used to pay any shortfalls if there are any. Keep that in mind. Okay.
So be sure to throw your questions up as we're going through this, so we're not too far away from the topic when we can handle those. So if you have any questions, just type them in.
Okay, assets. Now, typically the big problem I have here is these three fields. Your employer contributions. We do the limitations automatically. So if your client's making $50,000 a year, you can say 100%, and we'll put 100% in there, which is the limit of $24,000 or whatever, $24,500. So we won't put the full $25,000, full $50,000 in. If you put 100%, we'll put the limitation, whatever it is. Conversely, if you have a client making $500,000, let's say you have a client making $500,000 a year, and you go and put 5% in, and you say, well, 5% of 500,000 is $25,000. That's more than the limitation. Just understand, we do it by the books like the IRS says. And the IRS says it's 5% or whatever percentage you do of your income, or I think this year it's $275,000. There's a cap. So people think that we would do 5% of 50,000. No, we do 5% as the rule for the IRS. This has to do with matching rules. We do the limitations like the IRS says, and it's 5% of $275,000. So you want to make sure if the client's maxing, just put a very high percentage in. Doesn't matter what their income levels, we'll do it. And the reason, again, that's done that way is it's the IRS rule, is that they don't want this match to be 3% of $500,000. It's actually 3% of $275,000, because it's a way to prevent high income earners from getting a great match. So it's an IRS rule. I can't help it. That's how we do it. We do it by the books. So if you want to get the match, just put a high percentage in there. We'll cap it. Also, you'll see annual contributions. This is in addition to any contributions here and here, not separate, not alternate. So if I don't go say, oh, they're putting 24,000 in, so I'm going to put 20% here and 24,000 here. No. That will double it. This is in addition to this value here. Okay. Now, other issue.
Robert, we have a question here. Let me just throw it in. See, does the tax program have the caps for service pass-through entities, and can we model adding a defined benefit to lower one's income for qualified for the 20%?
Yeah, okay, so let's talk about that. So that's what this field would do. I would enter, if I had someone who's a self-employed individual, we wouldn't be a percentage of income because you wouldn't be entering income back here. That's a good question. This income is 401. This income is employee income. If they're self-employed, which I'm not doing their self-employed tax, If they got pass-through income, they're going to do self-employed income. You're going to come over here, put that there. And then under assets, you would use this field to put in, if they're putting the max on a SEP, $25,000, put that there, whatever it might be. Put that number in. You do not fill in these fields because these fields are tied to the client's income. Okay. Now, that said, one of the things we're going to be adding, you should have it within a week or so, is the ability to have a deferred comp in here. Right now, deferred comp, the biggest drawback is we treat these qualified assets as qualified assets subject to RMDs. Now, most people get a deferred comp, a non-qualified deferred comp. They have to, they can put money in and they can draw down, but they have to draw down on a 5-year fixed period. And I don't give you that option right now. I am working on that, and that will be available within a week or so. And that will give you the ability to have a qualified asset where you can control the distribution on a dollar basis for a specific period of time. All right? Now, one last thing to add, make sure you get the spouse and Roth correct, because we're tracking the spouse's income for these contributions, and we're tracking obviously the client's income for contributions. Please get that right. Same with Roth. If you're making contributions, you're going to lose deductibility. So just keep those concepts in mind. All right. Now, I'm going to roll down to non-qualified. Okay. One of the functions we've added recently, if you may have seen, is this. This allows you to tell the software on a monthly basis how much your client may be saving in additional to their 401ks until retirement. So you have the ability to save into an account until retirement. Please note something very important here. We're not going to, if you're saving it, we're putting it in there whether you have it or not. So don't force us to sell assets so that you can save. That should be a realistic savings. Don't go put $50,000 a month when your client has $500 a month. Get that correct. Basis, real important. Well, you'll notice the software puts a default of 90. I do that intentionally. I could leave it at 100. I do that intentionally just to wake people up. If you have, and so if you have all fixed assets here, make sure you change that to 100%. If the client, if you have a situation, I want you to try to at least get a reasonable understanding of the basis in this portfolio. And so if the balance in this is 1.561 and the basis is 1.23, that would be about a 75% basis. Get an estimate for that. We are tracking capital gains. It's not an exact science for you, I understand, but projecting also isn't exact science. We do want to get close though. All right. Now, people get this mixed up too. We also allow you to throw out a dividend on this. If you throw out a dividend, it's a percentage of the total portfolio. So if I was 50-50, but the dividend is only is 2% on this half, well, then the dividend really is only 1%. So get that correct, all right? Because the dividend is going to be paid out on the percentage of the portfolio balance, okay? And the kind of dividend is important too. Some people don't understand this, and I'll explain it real quick. We give you fields qualified, non-qualified, tax-free. Tax-free would be if you had a muni fund here. You were doing muni bonds, and that's 100% muni, and you want that money that they're living off the income stream of it. That's fine. Then that's tax-free. That's pretty self-explanatory. But qualified and non-qualified aren't quite as explanatory. Some stocks, okay, if you have a preferred stock, that preferred stock is going to be treated as non-qualified by the IRS. And what that means is, what qualified and non-qualified means is, qualified means it's subject to the benefit of being taxed at the capital gains rates, which are 10, 15, and 20%. Non-qualified means it doesn't qualify for those capital gains rates and will be taxed as ordinary income. So it'll be for bonds, preferred stock, and most utility stocks, even if they have common stock, most utility stocks are considered by the IRS as non-qualified. Those dividends will be treated as ordinary income. So that's an explanation of that, where people don't seem to understand that so much. Now, life insurance. Life insurance, there's not really too many problems I have with life insurance. I do, which we will not do today. We'll do in another seminar, is about how to import a template. I'm going to do that just quickly though for giggles. And I'm going to browse here. I created a template. And go here. Sorry, excuse me. Where is it? It's not there. Oh, it's under downloads. I'm sorry. There we go. I have a template here. It's been corrupted because I used it just recently for somebody. But what I did was I brought that template in. Now, if you're going to use this template, it has to be formatted to browse in is a comma separated value, and it's got to be labeled just like this. We will do that in another class that's more advanced, but I'm giving a heads up. If it doesn't work, it's for you. It's probably because you're typing the titles wrong. The titles has to be typed exactly like this for these columns. Okay? And you must do it that way. We'll get into more detail on that on another day. That said, next, this is long-term care. I'm going to go over this real quick. So the long-term care fields, the long-term care, this is the most common thing people get stuck on. I find one of the most common things. When dealing with long-term care should be a separate topic alone on its own, not part of your overall retirement plan. Why? Because resolving long-term care creates usually a need to show a baseline with a serious medical expense. That's the way to motivate the client to deal with long-term care. If I'm dealing with a retirement plan, though, I don't want to assume that my client's going to have a serious medical problem right here. It would make my solves very difficult, and it will blur the issues. What I generally would want to do with a long-term care situation is I only want to put the long-term care policy in or information in if the client doesn't have a policy. If the client already has a policy, you can go here, put it in, put the premium in. Do not put an expense in. No reason, no cause. You're not here to deal with a long-term care event for them. If they already got a policy, it's already been addressed. Don't put it in. Don't do it. Just if you want, you can put the premium in. That's it. Call it a day. If you're dealing with the long-term care issue, that's your goal, and you want to deal with it, you want to create a baseline with an expense only. So you have your monthly expense, and you can grow it, put it into that future expense of today's dollar. Start a month and a year in the future. Okay? Do not go putting the premium, and in this case, this person put in a benefit. Fortunately, they didn't start a year in which the benefit should be paid, i.e. an expense. Try to keep this as simple as possible. Create the expense in the baseline to motivate the client to see this is what will happen. Get their agreement to deal with the issue. If they want to deal with the issue, then you use the analysis section to put in your solution. A long-term care policy, a life insurance policy with a rider, and talk about that issue and that solution alone. If they agree that they're willing, because what will happen in long-term care to mitigate it will always cost us net worth. So to mitigate that issue, we want to deal with that immediately, get that set aside. If they say, I'm willing to give up some income now to solve this issue, I'll buy the long-term care policy, or I'll buy a life policy with a rider, whatever it might be. If they agree to that, good, done. I now use that information as my baseline to move on to solve my retirement needs without an expense, a long-term care expense. Get the solve first as a separate case. Then once we resolve it, they bought a life insurance policy or they bought a long-term care policy. Now I start a new plan and I add that in without the long-term care expense. And that's how I address that. So don't fill this in unless we're going to deal with long-term care. Yes.
So I was just going to comment. Usually I include the long-term care costs in the net income need on the client info page. I just lump that together, make sure I have enough money to cover it. And I'm usually inflating that 2, 3, 4%. But if I'm worried about that being a separate item, you can put it here. Or if you're proposing into the solution to buy long-term care that you have to create a new expense and gross that up for the tax, you're always adding a premium in here because you're adding a new expense to the solution. But generally speaking, for life insurance and for long-term care, I normally just make sure I lump that into the net income need, and I'm not doing it here unless if it's an existing contract, and let's say I got 5 years left in a 20-year pay secondary guarantee, and I want to be sure that just like when I paid my mortgage off, that I'm no longer showing a need for cash flow 5 years after I retire for life insurance, they'll be paid up. Then I may separate that payment out of the net income amount and actually put a premium amount in the detailed report of the life insurance tab. So so that I'm not that expense goes away at the right time. So you may have questions, specifically about it. And obviously, Robert's always a resource after this call, specifically drill into particular issues and how to do certain things. This is a more broad overview, making sure we make mistakes. And I don't know, Robert, did you cover the detail how to limit the limited pay kind of product that pays out?
I think we'll save that for a class on long-term care.
I was talking about the life insurance tab. There was a question about that, and that's why I was just mentioning that you could show a limited pay and have that cost go away.
Yes.
And you're in the tab, so I was just mentioning that.
Yeah, so of course I can come in here and have a premium for X amount of years and shut that off. But that's generally pretty self-explanatory. And again, I think we'll save this from today's not expensive.
And there, I see other questions for areas that we've already covered. And based on the time at the end of the call, I'll try to circle back and get your questions in before the top of the hour.
Okay. Annuities. Okay, the biggest problem, part of this, and I'm not here to go to train today. Today is to find mistakes, but we will do topics on testing annuities and testing long-term care. We'll do videos just on that. So today I wanted to focus on common mistakes. The biggest common mistakes I probably will tell you I'll run into, make sure you get this correct. Make sure you get your annuity correct. Don't make that mistake. Make sure you notify if it's a qualified plan. On SPIAs and DIAs, if it's a period certain, this year here is for period certain, not life contingent contracts. If you put 5 years here, it's for 5 years. If it's life only, that's fine, because that will reflect that on their investment net worth. You buy a life only policy, boom, it's not going to be on your balance sheet anymore because there's no installment refund or cash refund value. So keep that correct. All right. Excess cash flow. Most of the time you're not in this field. There shouldn't be too often, but let's talk about it. There's not a mistake issue here. The only mistake issues I want to deal with, I wouldn't say they're necessarily mistake issues. We make an assumption here on when we're doing an estimate net to heirs, we want to be kind of compare apples to apples. If your client inherits $1 million of qualified assets versus $1 million of non-qualified, it's not the same. Qualified assets have to be taxed, and we want to account for that as best we can. Obviously, we have no idea what tax bracket the kids will be in. We don't know how many kids there are. So you as the advisor have to kind of get your hands around that. And you don't know, what state your kids are in. If your kids are in New Jersey or New York or California or Illinois, they're in a high state tax area. So on top of their federal taxes, so if my client's kids make a decent income and they're in the 28% bracket, they're going to pay 28% on the federal and probably 7% or more on the state. California will be paying 10 to 13%. And so if that client's kids are top producers in those states, they're not paying 35. They may be paying 45 or 48%, maybe as much as 50. So we want to give an idea, and that's your job as advisors to set a reasonable expectation of what the client's heirs, what bracket they will be in, and make the assumption they don't do it over a lifetime, but they would take a lump sum settlement. I know it's the worst, and most people don't want to do it, but that's what we're trying to illustrate. So try to get that nailed down. The other thing is your state tax override over here. So for the people who do reside in states like California, New York, New Jersey, Connecticut, where you have a very progressive state income tax, a lot of states have a very level tax. We do not do a full tax return for each state. We do a federal return, but the states we do an estimate based on an average bracket. So the problem with that is if you have a high income earner in California, which is 13%, we're doing 7%, I believe, in California. So we may be undertaxing your client. Conversely, California is very progressive. If you have low income earners in California and retirees, they may not pay 7%. They may only pay 1 or 2% at best. Same goes like New Jersey. Low income earners pay almost nothing, and they make $30,000 a year. You're a single person making $30,000 a year in New Jersey, $40,000 a year with medical expenses as a retiree. You're probably paying no state income tax. But if you're a high earner, you're going to pay a lot. So you may need to override that. Just keep that in mind. Other things, tax adjustments. Make sure if you're doing any tax adjustments here, these tax adjustments are positive tax adjustments. Negative signs will allow negatives. So if you want to reduce your taxable income for some reason, you can. You want to reduce a capital gain, you can. You have a capital loss. But I don't do loss carryovers. And I'm not going to get too deep into that today. Just keep that in mind. And
Robert, we are on the life insurance tab. Jason asked the question, hey, what about if I'm taking income from life insurance? So though we're not covering it today, when you got to that detailed report where we were showing you could stop the premium payment, in the same way you can put in, and if you go out and get an actual illustration from the carrier and you got assumptions that you're very comfortable with illustrating, you can actually populate it right into the using this browser tool, and then it'll populate that for you. So you can show paying premium for so many years and then taking cash out as a withdrawal and basis for so many years. And so you can just populate the illustration right inside the hood. And that was a good question, Jason. So you can either do payments, you can show stop of payments, or you can show income tax-free out of this strategy. That's why we have life insurance as an asset class and life insurance as a death benefit fully displayed and illustrate inside the tool. Go ahead, Robert.
All right. So pretty much on the data entry, I've covered what you should be looking for as common errors. Now, I do want to account for one other thing now, and that is errors, and it's a very general, because I'm not going to do a class on this today. We don't have the time. But doing reports, I'm going to talk about. When you run your reports, first of all, you're going to see displayed here what your changes were. You'll see down here, we created boxes. Now, for those who do not have Adobe Write, they only have Adobe Read. When you have only Adobe Read, you cannot edit the report. The report is what it is, and you're going to be stuck with the canned report we provide. We do, however, let you create text in between each section of the reports, and this will give you ability to put in text right after each section. If you put something here, it will show up in a separate page following that section report. When I run the reports, couple errors when people run the reports. Asset analysis. With the asset analysis report, let me show you what that really does. If you scroll down here, you will see these charts here. These charts reflect the investment net worth, which is just the investment assets. The second chart incorporates any real estate value they have, less liabilities, plus the cash value in a life insurance policy. So now you're seeing not just the assets, but if I bought, so for example, if my client has a lot of rental properties, they may look at this and say, yeah, my red line's going low, but I've got millions in real estate property. And they feel that I'm cheating them, or then I'm not paying attention to that value. This would let them see that. Same if they had a lot in cash value life insurance, right? I'm not planning to sell your properties or liquidate your cash value in your life insurance. That's why it's not included here. And that's simply because I don't want to blow up your life policy or create capital gains in selling a property. We do not force the sales. They have to be done manually if they need the money. But here you can see what those values would be. This chart shows you the death benefit. So often clients think my red line maybe is below my green line, but that's because I bought life insurance. It's hiding the fact that, yeah, I'm falling behind with that red line because that doesn't show that I bought life insurance. Over here would show you the life insurance and what's the difference with net to heirs with life insurance, or excuse me, gross to heirs with life insurance. The final is going to show me the gross to heirs adjusted for income taxes on qualified assets. All right. Now, why I say that? So we have the reporting. Let's go back to case reporting. By default, we're including it. I generally don't include it. It's just a topic I don't need to include unless I need to include it. In other words, if I didn't sell any life insurance, I didn't add life insurance to the model, they don't have rental properties, it's an average customer, I'm not going to throw in an additional report just to have another report. So I would uncheck it. If I don't want my notes there, you can have them. Maybe you're using those note fields. Maybe you're using the note fields not for the client, but for yourself. Then don't make the mistake of adding your notes to the client's report. Get rid of the additional notes. All right. I think today I went over errors that you may make in generating a report and data entry. I'm not going over common recommendation errors today. That's a class into itself, might be 2 classes. I hope that was helpful today. We have some questions. Let's answer those questions.
Robert, I've got some questions here, and then because we really didn't get through all the material here in an hour, and we're getting to the top of the hour, and want to be respectful of everybody's time, we may go over here just a smidge. But I think we're going to pick up. I was just looking at the schedule. I think we're going to do another 1 hour, 1 o'clock next Friday. We'll do round 2 of this particular case study, input information. We'd like to hear from you via maybe email with some feedback after our call today, and we'll try to cover more next time. But let me just round out with some questions that we haven't yet addressed. So here's a question: does the tax program have the caps of services? Okay, no, I've actually answered that one. Here's the one I wanted. Can you add friends for the next generation and grandkids so that you can calculate the gifting ability? Also, how can we show a gift from an IRA to a charity? Robert, you want to handle that question?
Yeah. So right now, if you're doing gifting to an IRA to a charity, in the application, what you'd have to, right now you can't do it because I do as needed or RMD, right? So what we would have to, which I'm going to be putting in the next version within a week, the ability to define how much you're taking out of a given plan in a given year. If you do that, you can then add adjustments under the miscellaneous. Let's go there. You can make adjustments to your deductibility. Now, tax adjustments. You can make the adjustment to your taxable income by a reduction of the charity in whatever years you want to do. Couple things to note. We'll set that up for you so that you can do that and pull those dollars out if you want to do it in a period of time. That will be in the next update, but that will be separate and set aside. You may want to talk to me specifically about that because this is a little out of the class realm today. So I don't want to get too deep. That's not a data entry error. That's a planning strategy. But we will have that function for you probably within the week. And right now, go ahead.
I'm sorry, Robert. I didn't mean to interrupt.
Well, I was going to say, right now, all you could do is go to expenses, create a cash expense of, I don't know, $50,000 a year, which would force a draw out from your qualified assets, and then go over here and give yourself an AGI adjustment or a taxable income adjustment. Right?
So there's several questions about how do we get this replay? How do we get the recording? So what we're going to do is Josh is going to upload this to our YouTube account. We'll have this as a private. So we'll send everybody on this call that we have a link, and then we are going to find a place on the website, the RNG website, that only for users to privately be able to watch the video. We'll put a link out there, so we'll have a whole series of these videos by date organized on the site. But we will, within probably early next week, we'll get you an email sent out with the YouTube link, and that's a private link. You can certainly share it with anybody that you want. But we're trying to make these particular educations exclusive to the users only. So look for that email that will come out, and then and you'll see that link. So that was 2 or 3 of the questions. Let me see. And then we have just a couple more. Bear with me. And we will send out a new global invite for 1 o'clock tomorrow, or next Friday. We'll do another one. Okay, I'm seeing a lot of nice comments about the value of these sessions. So hopefully you'll see value and will help you guys be successful. Here's a question we missed earlier. Should you do 100% employee contribution to be safe? And I think he's talking about if they're maxing their 401k.
There's no harm in doing that. That will automatically, just you do 100% of your income. I'm not putting 100% income. I'm doing up to the limit, whatever the limit is.
Yeah.
Correct.
Let's see. What other question? Working with the, okay, that one we've answered. Let's see if I got any more. Adding defined benefit. We talked about that one. Let's see. Can you add fields to the next generation? Yeah, so we are definitely going to be talking about fields. By the way, there were several new additions to the plan. Can you tell them what one, that you had one update that was not just back office calculations, but one big update that gave a new feature that old users would not be looking for? What was that in the current update, Robert?
I went over that. We originally, and we still do have in the application, the ability to tell the software. Let me get there. Come on. Oh, I'm there. So we'll show you here at this field what the surplus is every given year. And what will happen is you have the ability to tell the software, I'll save X amount of percentage of my dollars. We found the clients wanted a little more control of that. And so we add, and I showed them earlier, Curtis, under assets,
okay.
You have the ability to now say on a monthly basis, you want to save additional dollars. You can tell the client you need to, or you should be, or they are saving additional dollars here. Okay. Again, there'll be a major update so that particularly for those who are using a bucket strategy from qualified plans, using what I find very popular is using Allianz 222 as a means of funding their short-term cash needs. We will add a qualified bucket we'll put on the other plans. It will be used for deferred comps, and it will also be used for retirement plan contribution. Retirement plan distributions for Social Security for charity, and also be available to use as a bucket strategy. Again, that will probably be available for you within next week. Okay.
So we have one more question, and then we're going to close down the call today. Bear with me while I locate that question again. Where does this is from my good friend Al. Hi, Al. How are you doing? Where does excess cash flows go?
Good question.
Auto loan gets paid. Where does the money go?
Okay, good. Very, very good question. And it reminded me of something. I know a lot of people don't do it yet or intimidated. Two things. One, to answer your question, excess cash flow flows into your non-qualified assets. If you have more than one non-qualified asset, it's going to prorate it into those accounts. So if you have $2 million in one account, $1 million in the other, and you have $300,000 of excess cash flow, well, $100,000 will go to that one account and $200,000 will go to the other. We prorate everything in. Secondly, good question someone brought up. Roth IRAs. If you're going to do some Roth conversions, remember to create a Roth IRA. Without a Roth IRA created, we're going to save the money into a Roth account without any yields. And so you're going to do a Roth conversion. You're going to take money out of your qualified that's getting a return, and you're going to deposit into a Roth account you didn't create. So we'll create one, but with no yield. You need to create a Roth account to deposit the money in for both the client or the spouse, whoever you're doing the Roth conversion for. So if doing a Roth conversion, do not forget to create a Roth account. Also, even if your client has no non-qualified assets, also do the same thing for your non-qualified assets. Open up an account, put $100 in it. I don't care. Tell them it's their checking account. But we need an account to invest the excess cash flow in and a return that you expect to get it. So if your client doesn't have a lot of non-qualified now, but they're going to start having a lot down the road, or they're going to get an inheritance, we need to deposit that and we need to make money on it. You'll have to guide us. You need to open up an account.
Yeah, so if you're saving excess cash flows and you're going, well, hey, my numbers didn't change, my dashboard didn't change. Well, if you didn't open up another account, label it, and put the allocations for performance in there, then it won't impact saving excess cash flows. But once you open it up so that there's a place for them to go, whether it's Roth or whether it's non-qualified, now it's going to populate. You should see an impact to your numbers and an impact to the dashboard. Robert, anything else before we go?
No, I think we covered it all.
All right, Joshua, anything on your end? You might be muted. All right, well, thanks for being on the call. We'll send you one out for next Friday at 1 o'clock. Have a great day and a good weekend.
Bye-bye.